What if your hard-earned money suddenly lost its value? Inflation is the gradual loss of purchasing power, reflected in rising prices over time. The inflation rate measures the average price increase of a basket of goods and services over a year. High inflation means prices are increasing quickly, while low inflation indicates slower price growth. Inflation can be contrasted with deflation, where prices decline and purchasing power increases. There are three types of inflation: demand pull, cost push, and built-in inflation. Demand pull inflation occurs when increased money supply boosts demand faster than production capacity. Cost push inflation results from rising production costs, leading to higher consumer prices. Built-in inflation happens when people expect current inflation rates to continue, causing a wage price spiral. An increase in the money supply is the root cause of inflation, playing out through various economic mechanisms. Monetary authorities can increase money supply by printing more money, devaluing currency, or loaning new money. Supply bottlenecks and shortages of key goods can also push prices up, contributing to inflation. When inflation occurs, money loses its purchasing power, affecting any sector or the entire economy. The expectation of inflation can further sustain money devaluation as workers demand higher wages and businesses charge more. Inflation impacts the cost of living, leading to a deceleration in economic growth. The Consumer Price Index, CPI, and Wholesale Price Index, WPI, are commonly used to measure inflation. CPI examines the weighted average of prices of a basket of goods and services essential for consumers. WPI measures price changes at the producer or wholesale level before reaching the retail market. Inflation can be viewed positively or negatively, depending on individual viewpoints and the rate of change. Those with tangible assets may benefit from inflation as it raises the value of their assets. However, buyers of such assets may not be happy, as they will need to spend more money. High and variable inflation rates can impose major costs on an economy, introducing uncertainty. Even low, stable inflation can lead to serious economic problems due to how new money enters the economy. The Cantillon effect describes how inflation distorts relative prices, wages, and rates of return. To combat inflation, monetary authorities manage the money supply and credit through monetary policy. The Federal Reserve aims for moderate long-term interest rates, price stability, and maximum employment. Hyperinflation, a period of inflation over 50% per month, can have devastating effects on an economy. Quantitative easing, QE, is a measure taken by central banks to support the economy during extreme conditions. Inflation can be controlled by keeping it within permissible limits to ensure smooth economic functioning. Stocks, commodities, and real estate are considered good hedges against inflation. Treasury inflation-protected securities, TIPS, are low-risk investments indexed to inflation. Inflation is a natural economic phenomenon, but it must be managed to prevent excessive price increases.